Well, hello, everybody. As we near the end of 2024, inevitably, we start thinking about what is 2025 going to look like. And I've been spending a decent amount of time doing exactly that. And I want to preface this by saying what we talk about on here is we review the data and I tell you the way things are and maybe even the way things were in very recent housing market history. What I'm about to do now is I'm going to talk about some things and maybe some very subtle predictions I have for sort of the short term future, i.e., next spring, next February, March, April, exactly that. These are conjecture. I don't have a crystal ball. If I did have a crystal ball, I don't know if I'd be putting it in a YouTube video. There might be higher and better uses if I was truly able to predict the market like that. And I would be aware of anybody who's selling you an absolutist view. But just given the way things are shaping up, this is one of the outcomes I think that is fairly likely for the market. So let's go ahead and get started. My name is Stephen Meade with Domicile Real Estate, where we are on a mission to help California's renters become homeowners. This is our Southern California whole housing market update for Los Angeles and LA counties for December 17th, 2024. Let's go ahead and get started. So this isn't a clickbaity headline. I am a little bit scared about what March is going to look like. And there's a couple of sort of red flags, canaries in the coal mine that I'm seeing in the data that lead me to believe this could be a very rocky spring for home buyers. Now, the flip side of that, right, is that if you're a home seller, this could be a better spring than maybe you had imagined. And I noticed there's some articles that are coming out that are saying some of similar things. And I think, well, they might have a little bit different reasons for me than I do for saying that. You know, I try to review the actual local data. One of the things that none of these national articles talk about is that they are based on sort of national information, but these markets are not homogenous. So, for example, right now, the housing market in Austin, Texas is significantly different than the housing market in Southern California, to the point where they're not even comparable. The strategies you would pursue as a buyer and a seller in these markets are not even remotely similar at the moment. So I try to take and make my predictions based on the data I am seeing here in Los Angeles and Orange counties, mainly under the $2 million price point, because that is where most of our viewers, honestly, that's where most of the market is in terms of units sold. So let's go ahead and jump into the stats, and I'm going to kind of weave into you where I'm seeing some of these warning signs. So let me pull everything up here. Okay. So if you'll bear with me just for a second, we're going to go back to the beginning of our slides here. All right, take a look at total active listings right now. So one of the things that you're going to look at here is we're seeing that the listings are going down. That is obviously to be expected. We probably are, again, you know, we're maybe about 30% above under $1 million in terms of that inventory than we were at last year. And this would normally be a good sign. The problem that I'm having, right, with this is I don't like a trend that we're going to see later on which houses are the ones that are selling. And that leads me to believe that some of this inventory might be what I call phantom inventory. What is phantom inventory? Well, phantom inventory is homes that are listed for sale, so they're active in our marketplace and our stats, but they are not necessarily motivated and or realistic sellers. And whenever I see that, that's a bit of a warning sign to me, because I think if you just run the stat, you would conclude that we have a lot more inventory than last year. This should be a way easier market for buyers. And yet it isn't as much easier as we would expect. So if we look at our new listings, we see something kind of interesting. You know, new listings tend to just dive towards the end of the year. We are, again, a little bit better than we were at last year, but I'm not entirely sure these are all the listings that buyers want. And if you watch this every 2 weeks, or you watch us every week, which hopefully you do, like, subscribe, etc., hit the notification bell, you'll notice that I kind of weave in this conversation, right, about how this market is better than it's been, but it doesn't feel as much better for buyers as it feels like it should be. And that we're just not seeing kind of the right inventory. There's still frustrations, like something's not adding up in this marketplace. And it's something that we've kind of felt for a long time. If we look at our new escrows, these tend to taper off as we go through the year. But you'll notice these don't taper off nearly as fast as those new listings, which just kind of drop off a cliff when we hit December, but buyers don't completely disappear. By the way, if you're a seller, take note of that. If you look at our absorption rate right here, you see something really interesting. If you look at this absorption rate, you see that it has fallen since last week's highs. I told you that was going to happen, but look at where this is compared to where we've been all year. So we're seeing that rate still pretty elevated. Is it as elevated as it was at this point last year? No, but I'm going to explain something about this inventory isn't sitting right with me. We're seeing a lot of stale houses. Going back through, if we look at closed prices, right, like this is something else you would expect with this improvement in numbers that we would have softer prices than last year. You would have expected this to have been a flat year versus last year. And in every level of the market, from that 25th percentile entry level and to the median to the 75th percentile, we are seeing that homes are, as of right now, selling for more than they were at this point last year. So this was not the flat year that everyone predicted. It was a year where prices grew. And so that should tell you something, that the problem we have is not so much that we don't have enough inventory overall, but maybe we don't have enough of the right inventory, and there's still some scarcity among the houses that people want. Excuse me. And then if we look at this percent active after 14 days on the market, this is another thing that kind of caught my eye. Look, since October, we have seen a downward progression on this stat. And downward actually means a more competitive market. If you look at where we were at last year, we're at about the same level approximately, but we didn't spend the rest of last year with this higher number. This is what's interesting, is that it's diving like this towards the end of the year. If we look at our listing close ratio, that has actually rebounded slightly, or we're back up over 100%, right? So interesting news there. And then if we look at our days on market for new contracts, that has gone up, right? And it's up versus last year. So why are we seeing days on market go up? But a lot of our other market statistics are telling us the market isn't less competitive than last year. How is that manifesting itself? Well, I can tell you that one possibility of this is that people are actually buying homes that have been sitting on the market. Why would they do that? Because they don't like the new homes that are coming up on the market, and they are revisiting older homes, maybe older homes that did have a price reduction. And I think when you start to look at that and you see that, now it starts to make sense that what we have is a quality problem on the inventory, either the quality in the houses itself or the value proposition, meaning how are they priced versus the market. And that, of course, is closely related to whether a seller is motivated or not. If we look at our affordability index, now we see something that kind of adds a little bit of intrigue, right? If you look at the right side of this graph, that gap between the rent index and the payment index is a very interesting one, because when it starts to drop below two segments, that tends to be when we tend to have price growth. And look at what is happening. A large function of this, of course, is we have seen some interest rates drop in the last week or two. And what that has done is, I think that is going to fuel our market through the holiday season. And I think we're going to end up with an earlier spring. And if you look here, we can see that outlined directly. So aside from the coughing, which please excuse me, I'm just finishing up with a cold. What does this really mean if you're a person who's out there in the marketplace? Well, if you're a seller, I'm going to tell you, hey, things are looking up. I'm expecting that next spring is going to be a great time for sellers. But if it's a buyer, it tells me something else that's really interesting, right? If you are a buyer, you might be thinking that if I wait, there's going to be this lull period in January where things are really slow and you're going to get a great deal. And I don't see that happening. Most of us have thought, and I still think that overall interest rate reductions in 2025 are going to be less maybe than we had hoped for and or anticipated. They're going to come more slowly. But this drop has been a little bit of a gift. And in our marketplace right now, we are incredibly interest rate sensitive, especially below $1 million. So if you're the kind of person who's sitting on the sidelines, this is now not the kind of time I would say to wait. I would say you should be preparing, getting pre-approved, looking, getting your ducks in order, because I don't think it's going to necessarily get easier for you if you wait until the spring. I think it's going to be a pretty brisk spring. Anyhow, that's all I've got for you. Thanks so much for watching. Don't forget to like, subscribe, hit that notification bell. And obviously, if we can help lend you our expertise, we would absolutely love to do that here in the Southern California area. Don't hesitate to reach out. Questions and comments, we love them. And we will see you again real soon.